Before I get into that, I have to do last year's predictions. I have to walk through what I predicted. I broke them down in predictions that hit the bullseye, predictions that hit the board, the dartboard, and predictions that missed the board. So what did I predict? I said headwinds in the equity markets would cause a market correction. The three major U.S. equities have all suffered losses, more than 20% at some point during this year. The only one that's not in a bear market is the Dow, given its rally that it's just had in the last few weeks. I predicted that the bubble in meme stocks and cryptocurrencies would pop. Pop they did. I predicted inflation would be structural, not transitory. Well, inflation has persisted, grinded higher, and even the Fed has acknowledged it's not transitory. I predicted unemployment rate would decline. Employers would struggle to find qualified candidates. The unemployment rate has continued to decline, and the labor markets remain tight. Political predictions that hit the bullseye, I nailed every single one of them. I'm not going to spend my time because I've got a lot to cover, but Build Back Better did not get done. Senator Manchin got his way. No major tax changes occurred. They did pass what I said, the global minimum tax of 15%, but no change in cap gains rates. Series of green energy policies, but as I said, you can take a look at that at your leisure. Predictions that were on the board. I said commercial real estate, but for office values would remain strong and capitalization rates low. Largely that has been the case throughout most of the year, but now cap rates are starting to rise and asset values starting to weaken. I predicted GDP growth would slow, remain positive in the first half of the year, but risk of recession in the second half. Well, GDP growth slowed and then turned slightly negative for the first 2 quarters, followed by a positive print of 2.6 in this most recent quarter. So my timing was a bit off. I said short-term rates would remain anchored at 0 for the first quarter and stay low in the summer. The Fed stayed low in the first quarter, made their first 25 basis point rate move at the end of March, and then started their more meaningful moves in May. And I said housing prices would stall and home values would correct 5 to 10%. I still think that's going to happen. But medium home prices continue to grind up through the early part of 2022 and now are starting to contract. And the one that was off the board entirely was I predicted that the 10-year Treasury yield would swing between 1.3 and 2.25. Well, as the Fed started really hiking rates, the 10-year Treasury grinded higher. It's been bouncing around to the high 3s, and this morning it's at 4.17. So all in all, a pretty darn good set of predictions. Now the problem is, how do you match that this coming year?